If you make $100,000 a year, or you and your partner add up to $100,000 combined, there are two completely different numbers you need to know before you look at a single house. Number one is what a lender will approve you for. Number two is what you can actually afford to live with. Those two numbers are usually thousands of dollars apart. My name's Ian, and I'm a mortgage broker here in Tampa, and I do this all day, every day for first-time buyers. I do this for investors, business owners, and all other members of our community. So I've watched this same mistake play out more times than I can count. A lender issues someone a pre-approval letter. The lender says, hey, you're good up to this dollar amount. And the buyers go shopping right at the very top of that amount. And then they end up not being able to afford their house. They end up house poor. They have a beautiful home with little to no breathing room, and I don't want that to be you. So stick with me, because near the end, I'm going to show you a simple test you could run before you ever make an offer. The test will tell you whether a payment is actually comfortable, and it quietly builds your down payment at the same time. And real quick, if you're house hunting this year, go ahead and hit that subscribe button. Everything on this channel builds on itself, and I do not want you to miss what's coming next. All right, let's go get into it. So those two numbers, the first one is the lender's number, which comes from your pre-approval. That's the most a lender is willing to hand to you. It's not a bad number. It's just not the number you want to go shopping with, because that number isn't built around your life. It's built around the lender's risk. And the second number would be your personal comfort number. That one comes from your actual budget, your real take-home pay, the payment you could live with every single month. The whole point of this video is to get you to fall in love with that second number. But first, let's start with how the lender gets to the first number. Because once you see under the hood, you'll understand exactly why their number is almost always too high for comfort. Lenders don't just look at how much you make, they look at how much debt you carry compared to how much you make. That's called your debt to income ratio, or DTI for short. Here's the simple version. They take your minimum monthly debt payments, stuff like your car payment, your minimum credit card payments, your student loans, and they compare that to your gross monthly income. Gross, that's your income before taxes, before anything comes out. You see how that could be a problem, because you don't spend your gross income, you spend what hits your bank account. But the lender's math is built on the bigger number. Now, there are actually two ratios at play. The first one is called the front end ratio. That's just your housing payment as a percentage of your income. The second one is the back end ratio. That's your housing payment plus all of your other debts. Cars, the cards, the student loans, as a percentage of your income, right? The lender runs both, and then they take the lower of the two. That becomes your maximum payment. And every loan program has its own limits. On an FHA loan, in the best case scenario, those ratios can stretch up to about 47% on the front end and about 57% on the back. Conventional loans don't really use a front end ratio. They lean on the back end, which can climb up towards 50%. USDA loans keep you on a much tighter leash, and VA loans barely even use DTI at all. They look at something called residual income, which is why VA can go even higher. Now read those numbers back to yourself for a second. 47%, 50%. That's the lender saying you can spend nearly half of your pre-tax income on housing. Would it be smart to actually do that? Well, in most cases, absolutely not. And hey, real quick note for my self-employed people, because this trips you up the most. A lot of you tell me, Ian, I make plenty of money. This approval number doesn't make sense. And I get it, because lenders don't qualify you based on what you deposit. They qualify you on what you net after write-offs on your tax returns. So your approval number can feel low compared to how you actually live, which makes understanding both numbers even more important for you. Now, what actually counts as debt here? What counts are things like car loans and leases, the minimum payment on your credit cards, student loans, and child support or alimony if you pay it. The rule of thumb, if it shows up on your credit report, it's going to be in the math. What does not count? Your rent, utilities, your phone bill, groceries, gas, car insurance, none of that is on your credit report. So the lender doesn't see it, which is pretty crazy when you think about it, because that stuff is your real life, right? And it's the exact stuff that gets tough to pay when your mortgage payment is high. So let me give you an example. I had a buyer, really strong income, excellent credit. The lender approved them for a payment near the top of that range. On paper, perfect. But that payment ate so much of their take-home pay that within a few months, they were charging groceries on their credit card, skipping the dinners out, were stressed every time they needed a small repair on their air conditioner. Nothing went wrong with the loan, though. The loan was fine. Their life was not fine. So that's not good. The lender's job ends at will they pay it back? Your job is everything that comes after. So here's the lesson on this part. When your lender hands you that max number, treat it as the ceiling, not the target. It's the most the system will allow, not the most you should do. Now, there are a few times when going right up to the max actually makes sense. If it's just you on the loan because your partner's credit isn't ready yet, but you've got household income that'll help carry the payment, that can work. If you've got a roommate covering part of the payment that's not on the loan, that can work. If you've got a raise or a bonus you're genuinely confident in, that can work. The theme there is simple. You can stretch when you've got something extra backing it up. What you don't want to do is stretch to the ceiling with nothing behind it but hope. So if the lender's number is the ceiling, how do you find your number, the comfortable one? Now, there are 100 affordability rules out there. You've got the 28-36 rule. You've got the use 25% of your take-home pay rule. You've got the 3 times your income, 2.5 times your income rule. And honestly, none of them are really wrong and none of them are right, because the right number is the one that fits your budget and your goals, not somebody's formula on the internet. But you've got to start somewhere. So here's where I'd start. Most people, 33% of your gross income on that $100,000 a year example, that lands you somewhere around $2,700 a month, which, depending on rates, taxes, and insurance here in Florida, puts you near a $375,000 home purchase price. That's just a starting line. If you're aggressive about paying off debt, go under it. If you want room for travel, vacation, and savings, and actually enjoying your money, go under it. If a specific house in a specific neighborhood is the thing that matters the most to you, and you've decided that on purpose, then maybe you go up. Okay, here's that test that I promised you earlier. This one's powerful, and almost nobody does it. I don't really know why. Let's say you're paying $2,000 a month in rent right now, but the home you're eyeing would run you $2,700 a month, right? That's a $700 job. So before you commit to anything, test it. Open a separate savings account and every single month move that difference, $700 straight into the savings account. You're making practice payments. You keep paying your rent like normal and you set aside the gap on top of it. Do that for 2 or 3 months and pay attention. Is it comfortable or is it stressful? Is it killing your ability to do the things that you actually enjoy? If it's comfortable, you just prove to yourself that you can handle the real payment. If it's stressful, you just saved yourself from a very expensive mistake and you adjust your number down. And here's the beautiful part of it either way. That savings account, it becomes your down payment. You can't lose with this. You either confirm your number or protect yourself, and you're building your down payment the entire time. Now I have to talk about the payment behind the payment, because when people picture a mortgage, they picture principal and interest, the loan part, right? But your real monthly payment includes a lot more than that. It's principal and interest, plus property taxes, plus homeowners insurance, plus mortgage insurance, if you have it, plus HOA dues if the property has them. And here in Florida, I'm going to be honest with you, straight up with you, insurance and taxes are not a footnote. They're a real chunk of the payment. Florida homeowners insurance is some of the highest in the country, and it's a line item that could make 2 identical looking homes have very different monthly costs. So when you're on Zillow staring at that estimated payment, scroll down and check it, because by default, those calculators often assume 20% down. Most buyers, let's be real, most buyers aren't putting 20% down. So that friendly little number you're looking at might jump several $100s a month the second that you put in your real down payment. Check the real inputs every time. And then beyond the mortgage payment itself, budget for the stuff renting hid from you. Utilities, electric, water, internet, and they go up when the house gets bigger or older. Maintenance and repairs. A decent rule of thumb is about 1% of the home's value per year. You don't want to drain your entire account on the down payment and closing costs and then have the water heater go out and end up on a credit card. And know that taxes and insurance tend to climb up over time. And HOA dues can jump on you as well. This is the full picture. The lender's max number quietly ignores. If $2,700 a month and a $375 home isn't where you want to be, hear me on this. Your first home does not need to be your forever home. So many people build wealth with a stepping stone approach. You buy that home that checks, I don't know, maybe half your boxes. You live in it, you pay it down. And historically, this is an average, by the way, not a promise, home values have appreciated around 4% a year over the long run. So a few years in, your loan balance is lower because you've been paying it down and your value is likely higher. That gap between the two is your equity, and that equity can become the down payment on a bigger home down the road, often with a similar monthly payment, especially if your income's grown and your debts come down by then. That's how people move up over time. It's not magic, it's just patience plus equity. So please, buy a home for your life, not for someone else's. Because here's the quiet truth. When you scroll past those gorgeous homes online and wonder how everyone affords them, a lot of them are maxed out. A lot of them are stretched thin to keep appearances. A lot of them can't afford it. You're not behind. You're just seeing the highlight reel. And at the end of the day, this is a home. It's not your whole life. Don't let the house get in the way of your life that you're trying to build. So let's bring it home. Two numbers: the lender's max, which is the ceiling built on their risk, and your comfortable number built on your take home pay, your full payment, and your actual goals. The simplest place to start: take your monthly income, multiply it by 0.33, subtract your monthly debts, and you've got a soft maximum that'll keep you some breathing room in your life. And if you're self-employed and you want to know what you can actually get approved for, that real ceiling number, so you can dial in what's comfortable underneath of it, that's exactly what my team does. There's a link below to book a quick call. We'll go through all of your numbers, figure out which programs fit the best, and get you a crystal clear image before you ever start shopping. And do me a favor, drop the monthly payment that you're comfortable with in the comments. I read all of them and I'm genuinely curious what range you're all looking at. I'll see you on the next one.